It's Friday the 13th, and welcome to the weekly recap brought to you by themortgagereel.com. Let's just jump right into this. There's a round of applause that's due, according to Wall Street, for Congress. A lot of Wall Street is finding some confidence in what Congress has done with their actions, with the usage of the TARP money that's finally coming to some type of accountability, and also the approval ratings of Timothy Geithner. You know, it's very interesting to hear analysts on CNBC across the country rate him between a B+ to an A- average. So it's reassuring that there's some type of confidence coming back into the marketplace. Now, really, what did this do and how did this translate to the market this week? Well, starting on Wednesday, we saw a lot of strong testaments from JP Morgan at Chase. We saw Bank of America. And then we saw Citibank basically saying, hey, take the TARP money and shove it. We're going to show a profit. We're going back to profitability. We've cut back, and now we're showing signs of strength. All of this is very, very good news because it's restoring some type of confidence in our financial system. Now, normally, keep in mind, when the stock market rallies as it did, between the tune of about 500 points, 3 consecutive days of positivity, normally in the mortgage world, we're feeling that we're losing ground, interest rates are going higher, mortgage-backed securities have to get a higher yield to attract the money back. This week, folks, we held very strong, which is reassuring news that a lot of the plans from the Federal Reserve are in place. The money that's out there being used to purchase mortgage-backed securities held strong. A lot of the money that we saw, all of this landslide in the Dow Jones Industrial, came from the cash sidelines that they had pulled out of the marketplace. So not necessarily pulling from the mortgage world, it's not necessarily pulling from the bond world, it's actually pulling from the cash sidelines. So very, very good news. We also wanted to point out some very key comments that were made just today about what's going on with the relationship with China. You know, it's kind of like what's going on in the credit card world. If this hasn't impacted you yet, it may or may not. There are a lot of people who are seeing their credit card limits being revoked. A lot of credit card companies no longer reissuing the credit cards. There's a lot of stuff going on with unsecured debt right now. It's very interesting to see how this works on a global level. The United States' biggest allies right now are China and Japan. And with those two being the strongest, what happens? They actually flexed a little bit, and now they're having some concerns, especially China, with the ability for the U.S. to repay their debts. So they addressed the concern, and now it's something that the United States obviously has to consider. They're one of the largest debt holders for the country. Now, moving long term, let's just focus on with interest rates for a moment. The next 3 weeks, there's going to be some big rulings on this mark-to-market accounting. In a nutshell, what had happened when mark-to-market accounting took place, it basically took the mortgage-backed securities, devalued them so substantially that this financial crisis went into a huge tailspin. It means that these assets that these banks were holding were now toxic, and that mark-to-market changed the valuation of these assets. So within the next 3 weeks, it's in front of Congress, it's in front of the Senate, the Financial Oversight Committee. All these things in government are going to be discussing with the Federal Reserve, Timothy Geithner, Ben Bernanke. They're going to be discussing on how to address it. For the first time in over 18.5 months since the subprime mortgage meltdown back in June of 2007, it's going to be addressed. And with this comes the renewed confidence that should some type of modification be made to mark-to-market accounting rules, it's a good one for you to have some research and background and just Google it and just read up on what mark-to-market accounting is. If that modification does come, banks will have a lot more endurance to free up the lending and make the liquidity crisis thaw away. They'll start the lending again. They'll get the money back out into the business. As businesses become more healthy, because now they can meet their lines of credit, to revolve business lines, to have cash flow, to make business work the way that it always has. These banks do that. What happens with unemployment? Those businesses can get back to being healthy, to showing the strength that they need to make the products that they have to use. Now, we saw a huge cutback in the trade this week, and that's because the U.S. as a people, we've all cut back on our spending habits, and that just goes to show that that hurts across the board. With that, retail sales for the first time actually blipped up slightly. How is that possible? Well, the numbers are there. We don't exactly know how the numbers translate, but they're there. So we have to think of the trickle-down effect, that should the mark-to-market accounting rule be modified, not thrown away, be modified, and the banks benefit from that, they will begin to lend. If they begin to lend, business can get back on some type of normal pace. As they can expand and grow business again, job comes back, if unemployment starts to subside slightly, then what happens is consumer confidence comes back. Now, we're not the chief economists here. This is just our 10 cents of economy, but you can kind of see the domino effect here. That's what we're really looking forward to or rooting for. It's been a lot of good news that came out this week. We are hoping, praying, whatever you want to do, that this is going to continue into next week. Should this keep the pattern for the next 2 to 3 weeks until that new law is passed on market-to-market accounting adjustments, we could see some type of bottoming in the marketplace. Wall Street is starting to discuss it. They still think it's a bull market, a bear market instead of a bullish market, meaning that it's still at the bottoms. There's no confidence. But it has to come from the financial banking system. Last piece we want to touch on is this just might be a generalization, but we want to just put it out there. In the last recession in 2003, one of the first things to come back was real estate. It came back because interest rates went to a point where all homeowners began to refinance and restructure debt, and then real estate began to have its floor, and then value started to come back slowly. Unfortunately, because so many people restructured debt and got so healthy, and loose credit guidelines, everything led up until where we're at, people overspent outside of their means. Now, retracting that, obviously, we have a hard lesson learned as we move forward as a country, but it is a lesson that we have learned and that will make us stronger. Now, that might be taking some words from Obama, but we just wanted to reiterate that change is coming, and it still is coming for us. And the signs are more optimistic at this point because of some changes that are in place of what that could do to the future of banking and finance and the consumer confidence that will come back from it, and how it'll trickle down to unemployment. So we just want to say this is a very good week for us in the mortgage world. We held strong. Interest rates are still right at the 5% mark. We were afraid of them going much higher because of the losses we take from Wall Street having a huge rally. Stay tuned. As you'll also see, as a quick note, thank you for everyone for your support in themortgagereel.com. You'll see that the web page has been redesigned, relaid out. It's much more user-friendly, and the comments are starting to flow in, so we really appreciate the feedback. Stay tuned for the Professionals Corner as we get ready to launch that. That's going to be a huge resource for not only new homeowners, but existing homeowners. It's going to start from just your first-time home buyer all the way up to the grandparents or people who want to pass on that real estate wealth to the next generation. There's going to be advice from several different financial advisors, just everyone that has a profession that can somehow impact housing. You're going to have that resource now on themortgagereel.com. So we're bringing that to you real soon. We're excited to launch these new programs, and a lot more of the classes and seminars are coming. So stay tuned to our events calendar also, because we're really looking to make a positive impact with some very, very strong partnerships. Media, we're going to hopefully catch their attention. Our goal is to basically have some media coverage, how we're positively impacting our local community, our marketplace, and most importantly, to everyone viewing, our homeowners. Thank you very much for the overwhelming support, and we'll be back in touch soon.